Hey, everybody. Thanks for joining me on Investing Made Simple. My name is Ken Wilson. I am a former financial advisor. I am relicensing again, but I have over 8 years or so of investing experience, and I've decided to put together this program to help the beginner and even the intermediate level investor. You'll see me posting different videos, but it's going to be very basic information. I don't get real deep into the woods with these programs, and neither will I be recommending specific investments that's outside of the purpose of this program. I've worked with a number of different clients, investments, different investor types, from the stock jock to the person who simply wants to invest in very conservative investments. And so I'm going to offer everything to you that I know, and I hope that you get something out of it. Having said that, we're going to get started. And thanks again for joining me. So, if we're going to talk about investing, we need to talk about what investing is, first of all. And you're going to see me kind of looking at my screen from time to time and joining you back on the camera here. So, bear with me during those moments. But investing when I was a child was spoken of as anything that you buy that you spend kind of a good chunk of money on, a good pair of shoes or an automobile or something. And I would hear people say, I'm going to invest in a car or invest in a good pair of shoes. And truly, those were good things, but that's not investing. Investing is in putting money into something that you expect to appreciate in value. And those items do what? They depreciate in value. And so if you don't believe me, go buy a car and then go back and try to sell that car to that same dealership for what you bought it at. There, it's going to depreciate like overnight. And so investing formally, to give you a formal definition, is the act of putting money, time, or resources into something with the expectation of earning a profit or gain over time. All right. Um, I started investing when I was like 19 years old in the 401k for that the company had when I was in college. Thankfully, I was smart enough to see that as an opportunity, and that's where I got started. And really, I've never stopped. It's an exciting world. It's one that you should be participating in, even if it's just a little bit. So next, we're going to talk about what the stock market is. What is the stock market? The stock market is a place where investors buy and sell ownership shares, that is, stocks of companies. You'll also hear them referred to as equities. It is not a single physical place anymore. All the trading happens electronically. All right, so that's what the stock market is. And if we're going to talk about investing, you really need to understand the stock market, what it is, and then why it exists, which you're going to talk about right now. So, what are the functions of the stock market? Well, number one, it's to raise capital for companies. That's the number one reason why companies issue stocks. And secondly, the stock market provides liquidity. That's a term that you're going to hear me use a few times in these videos. And that is, investors can buy and sell their shares pretty easily on the stock market. So it provides liquidity. And thirdly, it reflects our economy. It really is a good measurement of how well or how poorly our economy is doing. That's why the stock market exists, for those three reasons. So we're going to get into some terms here next that are very important to you doing well in investing. All right, so stay tuned. All right, so the first term that we're going to learn here is diversification. Diversification. It's right there on your screen. And so you see the basket of eggs. It's the term, the phrase, don't put all of your eggs in one basket. That's what that's talking about. because if you drop that basket of eggs, then you've lost all of your eggs. But if you spread your eggs out over several baskets, there's a good chance that some of those eggs will make it home. All right. So investing is the same way. The more diversified you are, the better off and the less risk you take on. And so that's the purpose of it. Diversification is an investment strategy where you spread your money across different types of assets, industries, or geographic regions to reduce risk. So the whole reason why you've spread out your assets or your time or resources is to reduce the amount of risk that you take on. And so we'll talk about the next one, asset allocation. So the term asset allocation is very similar in its meaning to diversification, but it runs a little deeper. And so asset allocation is the process of dividing our investments among different asset classes, much like diversification, like stocks, bonds, cash, and other things, to balance risk and reward based on your financial goals, time horizon, or risk tolerance. So we introduced some new terms there: risk, goals, time horizon. So all of those mean that you are now working on your asset allocations, the way that they're divided up. But as I said, it runs a little deeper. So let's talk about risk tolerance. So you really can't talk about investing without addressing risk, because risk is inherent in any investment that you make in general. And so, what is risk? Risk is simply the potential for loss, right? And that potential is a lot greater with some investments and a lot less with others. Okay. So when we talk about risk, we have to also then determine what your risk tolerance would be as an investor. And here's the definition of that. It is the degree of comfort or willingness an investor has to take on the possibility of losing money in order to achieve potential investment returns. That's very wordy, I know. It's basically how comfortable you are with the possible loss to pursue potential gains. That's all it is. How comfortable, and different investors have a different level of comfort with the potential for loss. That's why it's called a risk tolerance. And we're going to talk more about that in just a bit. But keep this in mind: the higher your risk tolerance, we call that the more aggressive you are as an investor. The lower your risk tolerance, we call that the more conservative an investor you happen to be. All right. So you'll notice on the screen there what I refer to as the risk tolerance scale. And all that's illustrating is exactly what I just talked about. On the left side, you see conservative. That means that an investor has a conservative risk tolerance. And then if you go right of that, you see moderately conservative, moderate, all the way to the furthest end of the spectrum on the right is called an aggressive minded investor. And so, and underneath each one of those descriptors are the things that we mean. That's what we mean when we say conservative or moderately conservative. So you may want to, clip that or pause the video to study that a bit. I will make these resources available at the end for you to have. But you'll notice on the top of those colors of those bars are different investments or what we call asset classes. So the most conservative asset class would be government treasuries. Okay. And so that correlates to that risk tolerance or that particular level of risk. The further right you go, the more aggressive those asset classes are considered to be, to the degree that on the furthest, on the furthest the right, you have stocks. Stocks then are considered to be the most aggressive for the purposes of our classes. All right, so that's the risk tolerance scale. The reason why we talk about risk tolerance is because if you're invested in a way that doesn't align with your risk tolerance, then we say, as in the industry, that you are not in suitable investments. They don't fit what you are as an investor, as far as your risk profile. And so, financial advisors are very well trained to ascertain what your level of risk may be. All right. So let's talk about then next uh, what the different asset classes happen to be. So the first asset class we're going to talk about is the one that most people have heard about, and that would be stocks, also called equities, because you have ownership in a company when you buy a stock. I don't know about you, but I was very excited about the potential of owning, shares in, say, Coca-Cola, and not just consuming their products, but actually benefiting from owning, some of their stocks, or Johnson and Johnson, or whatever, stock, that tickles your fancy. It's very exciting to be a part owner, in my opinion, of companies. So, stocks, to give you a formal definition, they represent ownership in a company. When you buy a stock, you're buying a share of the company. And that means that you own a small piece of its assets and its earnings. All right. Companies sell stocks to raise money, as we said, for things like growing the business, for developing new products, and then for paying off debt. Those are the three main reasons why companies issue stocks. When a company sells stocks for the first time, sells their shares, it's called an initial public offering. You may hear that referred to as an IPO, an initial public offering. So whenever you hear that, your ears should perk up, because that's an opportunity to get in on the bottom floor there, of a company that's newly issuing stocks. Also, stocks generate returns two different ways. Number one, obviously, the stock can increase in value. That's the number one way that it returns to an investor. Secondly, is it issues dividends. All right, it's a dividend paying stock. Not all stocks are dividend paying stocks. And even if a company has issued dividends in the past, they're not required to. It all depends on what their economic position is, if you will. And so, if you want to know what stocks are dividend paying stocks, just do a search on Chat GPT or on Google, and, search stock or dividend paying stocks. It'll give you a very healthy list of stocks that pay dividends. And if I were you, I would look to see how long those particular companies have issued, or how consistently, you might say, because generally speaking, those companies will continue to offer dividends. And so, if we drill down a little deeper, as far as dividends go, let's say we're talking about Nike, and Nike says we're going to issue a dollar dividend per stock that you hold in our company. That means that in a year's time, each stock will have been paid $1 per stock, and dividends are issued every quarter, every 3 months. So that means that you would receive 25 cents each quarter for each stock that you hold for, in this case, Nike. And at the end of the year, obviously, you'll have gotten $1 per stock. It's a really astute way of investing, and some people do what we call dividend investing. They have dividend strategies with mutual funds that we're going to talk about later, and with stocks. and they just keep reinvesting them and they just compound. And so dividends is a good way to build wealth. Um, the prices, the stock market behaves based upon prices rising and falling. Okay, the prices of stocks rise and fall, I should say, based on market behavior. Um, Meaning, if more people want to buy than sell, then the market goes up. If more people are selling than buying, then the market goes down. Okay. Case in point, what happened in 1929? Um, People rushed to sell their stocks, and to the degree that it threw our economy into a depression in 1930. That's an extreme example, but that's why it happened, because people there was a big sell-off. What happened in '01? A bust. The internet bubble burst. People sold. What happened in '08? The housing crisis. Big problem. So, big sell off. So, that's what happens. Right now, our market has been cruising upward for a good number of months, if dare I say, a couple of years at least. And so there's not been a lot of big sell-offs, and that's why the market continues to rise. So a little bit more on stocks. Stocks are sold on exchanges like the New York Stock Exchange or the Nasdaq, and you buy them through brokerage accounts. You buy them through investment apps, even and retirement accounts. Even some retirement accounts allow you to buy stocks within your accounts now. Let's talk about the risks and other things concerning stocks. So, what are the risks inherent within stocks, buying stocks? Well, number one, the prices can go down. The prices of stocks go up and they go down. That's the number one risk. So, in that way, you can lose money, right? Um, Secondly, there is company specific risks, meaning the company could be poorly managed. The competition could be putting pressure on the other company's stock and it's therefore decreasing. And that's why we talk about people diversifying, or the necessity for investors to diversify. Um, who buys stocks? What people buy stocks. Um, People buy stocks because of historically strong ups and long-term returns. People buy stocks because of historically long-term returns. I think it's like 8 to 10% long-term that the market has returned pretty consistently long-term. Secondly, people buy stocks because it's an opportunity to grow wealth. If you invest the right way, over time, you could become very wealthy as a stock investor. And you can also beat inflation over time. Inflation is constantly running. And so people use stock as a hedge against inflation. And most of the time, they outpace inflation, the growth of inflation. Let's talk about the tax treatment of stocks next. So, how are stocks taxed? Well, number one, the phrase capital gains, you've heard that. That's how stocks are taxed. You're taxed when you sell a stock for a profit, not while holding it, only when you sell it. And you will be assessed either a short term gain or a long term gain. If you hold a stock for 1 year or less and you sell it, then you're going to incur a short term capital gains. And that is taxed at ordinary income. Whatever your income tax rate is, that's how it's taxed. It is the highest rate for stock gains. If you hold that for a year or longer, that is considered a long-term capital gains, and it's going to be lower than short-term, of course. That is anywhere from 0 to 15 to 20%, and it depends on your taxable income, basically. All right, so that's how stocks are taxed. Well, then how are dividends taxed? If a stock pays a dividend, those are usually taxable in the year you receive them. And there's what we call ordinary or qualified, that is qualified dividends, and then there are ordinary dividends. Qualified dividends meets the IRS requirement to be considered qualified, and they are taxed as long-term capital gains rates. Ordinary income dividends, that is, are considered non-qualified or ordinary dividends. They are taxed at ordinary income tax rates. All right. What about stocks within retirement accounts? How are those taxed? Stocks held inside of certain accounts may be tax advantaged, like 401ks or traditional IRAs. Taxes are paid when you withdraw uh, as ordinary income. Okay, only when you withdraw. Then you have Roth IRAs. Of course, uh, funds that go into Roth IRAs have already been taxed. So they grow and they distribute tax free in Roth IRAs. All right. So just like you can have capital gains, you can have capital losses. And so if you sell a stock at a loss, losses can offset gains. And that means that uh, you can you can use up to $3,000 of loss per year to offset ordinary income. $3,000 per year. What if you had a $15,000 loss in stocks? Well, you can use 3,000 of that for that year, and then for the next 5 years, because 3 times 5 is 15,000. You simply have to carry those additional losses forward for the next 4 years. All right. Okay, so here's a stock taxation example. So this person bought a stock at $1,000. They spent $1,000 and they bought stock. They sold those shares for $1,500 after 2 years. So that's a long-term gain of $500 because it was more than a year, right, that they held it. So that person then would be taxed according to their income from 0 to 20% on that $500 increase. All right. All right. So next we're going to talk about bonds. Bonds are issued by different entities. You have the federal government that issue bonds, which we're going to talk about next. States and other municipalities and city agencies issue bonds. Corporations issue bonds. But keep this in mind, a bond is simply a debt instrument. Okay, what do we mean? When a company issues bonds, let's say the federal government issues bonds, they may issue a $50 million bond. Okay. And when you say, hey, I want to invest in that bond the government just issued because it's paying a 4% interest or 4% coupon, it's the same word, it's interchangeable. Then what you do is, let's say you bought $10,000 of that bond. That means that you have made a loan to the federal government. And in return, the federal government has promised you two things: to pay you interest over the life of that bond until it matures. And they've also promised to pay you all of your principal back, the $10,000 that you invested at the end of that bond, once that bond matures. So you make your money, you get all your money back. It's a really sweet deal. And you don't see that with any other investment types uh, other than bonds. So you'll get interest generally 2 times a year, and then you'll get all of your principal back at maturity. So, more specifically, concerning government bonds, it's a loan that an investor makes to a government, as I said, and in return, the government promises to pay interest at regular intervals every 6 months. And they promise to repay the original the original amount invested, which of course is your principal at maturity, the length of the bond repayment. The length of repayment varies. It can be a 5 year bond, 10-year bond, 15, 20, 30-year bond. So then the federal government will issue a bond with a coupon or an interest rate attached to it. Let's say, do some math. Let's say the federal government issues a $5 million bond, and you decide to pay or to buy a $10,000 portion of that bond, and it has a 4% coupon or interest rate. That means every year you're going to get 4% or $400 paid out to you of interest. And it's generally going to be divided up into two payments, that is, every 6 months. And you'll get that for the life of that bond until it matures. And at the end of that, at that maturity date, you will get all of your principal back. Pretty sweet deal. Bonds are used to fund things like, at least government bonds, federal bonds are used to fund things like public services, infrastructure, and national operations. Um, why do people choose to invest in government bonds? Number one, for the safety and the stability of it. It's the US government we're talking about. So it's the safest investment aside from CDs and money markets and those types of instruments. People also invest in government bonds because of the predictable income. As we said, every 6 months, you'll get a check. Um, and thirdly, because of the capital preservation, your principal is pretty safe. And so that entices the certain types of people. And fourthly, to diversify your portfolio. You may have some very aggressive things out there, and you want to diversify and kind of balance your portfolio a bit. And so you'll buy something conservative like federal bonds, US bonds. Um, US government bonds are especially popular with retirees, conservative investors, and institutions because they don't want to lose people's money. So they'll put them in something like that. The risk associated with bonds, you say, well, how can there be risk? There's risk with anything. It's just a different type of risk, meaning there's something called interest rate risk. That means that interest rates, as interest rates go up, bond prices go down. Okay. It's called an inverse relationship. As interest rates go up, bond prices go down. Now, that's not critical unless you choose to sell your bond prior to the maturity date, because during that time of the bond life, the price is going to be going up and down. So you could sell when the price is up, you could sell when the price is down. The second type of risk is called inflation risk with bonds, meaning um, you can lose purchasing power, meaning you're not keeping track with inflation. Your interest rate is being outpaced by inflation. And thirdly, there's a credit risk anytime you talk about a bond because you're making a loan to somebody. And so their credit rating has a lot to do with whether or not they default or whether or not they can repay the loan. Well, we're talking about the federal government here, right? So it's not likely that the federal government is going to go defunct or go into default. All right. You will see credit rate as more important with some other types of bonds we're going to talk about later. All right. Next, we're going to talk about taxation of government bonds. All right, so how are government bonds, US government bonds, taxed? They are taxed at the federal level, and that's it. They are capital gains. You will be assessed if you sell them before maturity and you sell at a premium, meaning you sold for more than you bought it at. You'll be taxed federally for that. Um, Government treasuries, so in addition to bonds, you have what we call bills and you have notes. They are all held for a particular length of time. The shortest holding time would be a T bill. If you buy a T bill, government treasury, you hold that from weeks to about a year, no more than a year. And in the case of T bills, no interest payments are made. You buy it at a discount, okay? So that when you sell it at a gain. You sell it for more than you bought it at. So there is no interest being paid out. You're only holding it for weeks to a year. And then secondly, treasury notes are you hold those for a medium term, which is 2 to 10 years. 2 to 10 years. And then treasury bonds that we've been talking about, those are held the longest. You hold those from 20 to 30 years. So the kind of returns you can expect on government bonds coincide really with or correlate to the length of time you hold them. In the case of the shortest period, you can expect anywhere from 2 to 3% return. Uh, with intermediate from 2 to 10 years, you can expect 3 to 4% returns. And then long term, 20 to 30 year holdings of government bonds, you can expect 5 to 6% return. Those are all considered conservative returns. Remember, we're talking about safe investments. The safer the investment, the lower the return is going to be. The riskier the investment, the greater the return potential, but also the greater the potential for loss. Okay. So, how do you buy federal government bonds? A number of different ways. The number one way is to buy them directly through the federal government, right? So, you'd go on to treasuredirect.gov and you'd buy them directly. The benefit of going that way is you don't pay any fees or commissions. The bonds are guaranteed to be authentic and they are ideal for buy and hold investors because there's not a whole lot of selling to be done on the government website. So there's not a big market there. And that's one of the drawbacks. One of the drawbacks is there's limited availability to sell your bonds before maturity. And secondly, it is a very basic website. So you're not talking about anything sophisticated. You're talking about the federal government. Okay. Um, the second way to buy US government bonds is through brokerage accounts. I have them listed right there: Fidelity, Schwab, Vanguard, E Trade, TD Ameritrade. You would just go on their website and set up your account. It's going to ask you to attach your bank account to that. That's how you fund your account on your brokerage accounts. And then you will click buy or trade. All right, buy or trade. And then that's going to open up all of the different investment types and asset classes that you can buy on those brokerage websites. In this case, you would click on bonds and select government bonds. All right. So the benefits of buying through brokerage accounts is it's easy to sell those bonds before maturity because there's a market for them. You can hold treasuries or government treasuries alongside stocks and other funds, so you can have everything in one place. And then there's often no commissions on U.S. government treasuries or treasuries. The drawbacks is it's the secondary market, so you may pay a small markup. That's how they make their money by selling the bond. Third way is you can buy bonds inside of what we call exchange traded funds or ETFs. And you can buy them, of course, inside of mutual funds. Um, so we're going to talk about those asset classes later. But the benefit of buying through those two types of funds is that you're highly liquid. You can sell easily. In 1 to 2 days, you can have money in your account, your bank account. And then it provides instant diversification. We talked about that earlier. Diversification is spreading your money, your resources over multiple assets or asset classes. In the case of funds, you are instantly diversified because you have a whole lot of bonds inside of one instrument called a fund. And we're going to talk a little bit more about mutual funds later. One of the drawbacks to buying through ETFs and mutual funds is you do not get your guarantee of principal at a maturity date. There is no maturity date. You don't get your principal back, okay? Because you're no longer talking about an individual bond, you're talking about a fund now, and that doesn't happen there. Secondly, there are ongoing expense ratios, which is simply a percentage of an expense according to whatever holdings or amount you have at a fund. All right. One other way that you can buy is through retirement accounts. That's largely how most people learn about mutual funds is when they invest in their 401ks. But you can also buy them through IRAs and Roth IRAs. Again, those are going to be funds. All right. So we're going to define what funds are now and the different types there are out there. So, what is a fund? Okay, glad you asked. A fund is a pool of money from many investors used to buy a mix of assets, such as stocks, bonds, cash or cash equivalents, and other investments. Um, to make it very simple, a fund is likened to a swimming pool that has a lot of people in it. And those people would be the stocks and whatever other investments. And then who do you have sitting in a very tall chair watching over everyone, making sure that they're safe? You have the lifeguard. And that lifeguard is equivalent to what we call a fund manager at a fund. And the fund manager's job is just like a lifeguard to make sure that the stocks and the other investments are doing well. So, what does a lifeguard do when a person starts struggling and going down? They jump into the pool and they save that person and they pull them out of the pool. That's what a fund manager does. If a stock starts struggling or an investment they're unhappy with, it's not performing well, they pull it out of the fund. And there's so many other funds that it doesn't make a difference that has been pulled out, but they don't want that fund to stay in there any longer. And that's what a fund is. There are different types of funds. We're going to talk about them. One is called a mutual fund, and one is called an exchange traded fund. We're going to talk about the differences. Mutual funds are bought and sold at what is called NAV. NAV. That stands for net asset value, and it's assessed one time a day. Okay. ETFs trade all day like stocks, and you can buy them all day because they are traded on an exchange. Okay. Mutual funds are often actively managed. We talked about the lifeguard, right? The fund manager. That person is actively managing the fund. ETFs are usually passively managed. They're not managed generally. The way ETFs work is they track what we call indexes. So, whatever a particular index is doing, that's what the ETF does. It's called tracking an index. Mutual funds are typically higher in cost um, because you have a manager, a fund manager that's actively overlooking it. They're paid very well. And also, there's a lot going on inside of a mutual fund that you generally don't see inside of ETFs. And so ETFs are generally lower in cost. Um, what happens within a mutual fund when, I told you the lifeguard or the fund manager pulls out a stock or whatever and they will sell that? Well, that's a taxable event, and those taxable events are passed on to the investors. Small though they may be, they are still a cost, whereas with ETFs you tend to not see that because there's not a whole lot of that going on inside of ETFs. All right, so that's the difference between ETFs and mutual funds. All right, so we're going to talk about the different types of mutual funds, and they are many, but it's necessary for you to become educated about these. The first one is called a stock or equity mutual fund, and it's just that. It's a fund that invests primarily in stocks. They are higher risk because there's a higher return potential, or I should say, and there's a higher return potential. Um, Stock mutual funds invest in different ways. Number one, by company size. So you may have heard of what's called large cap funds, medium cap funds, or mid cap funds, and small cap funds. What that simply means is the size of company that invests in that particular fund. So, in the case of large cap funds, I think a company has to be valued at like $50 billion, right? And then down to mid cap, that's going to be a lesser valuation, and then small cap funds. Small cap funds are going to be a little riskier because there's not a lot, there's not a bigger market, as big a market for small cap funds than you would have with your large cap funds. Stock funds also invest by investment style. And what I mean by that is you may have what's called a growth fund, you may have a value fund, or you may have a blend of those two. What that means is growth funds are expected to outpace the market in its growth. Okay. Value funds are funds that may be undervalued. People think that over time they're going to grow real nicely. So that's what those two mean. And then a blend would be a combination of the two. You can also see funds invested by geography. That is, you may see the term US domestic funds, or international funds, or global funds, or emerging market funds. Those are all geographic funds. And then you may have funds by sector or by industry. So you may see things like technology funds, healthcare funds, energy, consumer goods, utilities, right? Real estate. Those are all sector or industry funds. And then you have funds called fixed income funds. What do you think those would be? We just talked about income producing bonds, right? So you have what's called bond funds. So, like you have an individual bond, well, a bond fund is a lot of bonds in one fund, as we talked about earlier. Bond funds invest primarily in bonds. They are lower risk, so a lower potential for loss, and they provide steady income, just like an individual bond. Bond funds provide steady income. You may have bond funds that are by issuer, meaning a government can issue them, corporations can issue them, municipalities can issue them, right? And we'll talk about those in a bit. Bond funds are issued by credit quality, okay? Credit quality. You have investment grade bond funds, and then you have high yield bond funds. They're also called junk bond funds. Okay. Uh, they're called junk bonds because they're issued by companies that have less than stellar credit ratings. All right. So they're not really junk, it's just the term that's been assigned to them. And then you have bonds that are invested by maturity, bond funds, that is. Just like individual bonds, you have short term, long term, and medium term bond funds. So the bonds within that fund range uh, in terms of duration, like regular bonds. And next, you have what's called the balanced or hybrid. Those are funds that have a mix of stocks and bonds, and they provide moderate risk because of that. They're kind of in the middle of the risk tolerance scale. The more stocks that are in a balanced fund, then the more risk that particular fund has. The more bonds, then the less risk there is associated with or within that balanced fund, mutual fund. And then the one that you're most familiar with, probably, if you invest in a 401k, is what's called target date funds. And those automatically adjust asset allocation. They automatically adjust for you. You don't have to do much. If you're expected to retire in 2040, then you buy a 2040 fund. All right. Um, so you also have something called a socially responsible fund. That is a fund that invests based on ethical, social, or environmental criteria. They do socially invest. I'm sorry, socially responsible investing, and they also include faith-based funds. All right. So next, we're going to talk about why you would choose a mutual fund uh, over other investments, or in addition to other investments. Number one, because you like the idea of a professionally managed fund. You got an expert overseeing your funds. So whenever you buy a fund, you want to read up on who the fund manager is. You also want automatic monthly investing. A mutual fund, automatic. You can set it up to where it automatically invests. Um, and then there's investing inside of your 401k or retirement plan. That's why you would buy a mutual fund. It may be your only option. And lastly, because you're comfortable with higher fees, because you expect that the mutual fund over time can outperform the market. And in some cases, they do. Why would you choose an ETF? You would choose an exchange traded fund because you want low cost and flexibility, because you prefer tax efficiencies. Remember, there's not a lot of trading happening within the fund, so those costs are not paid up, are not, those tax consequences are not forwarded to you. You like the ability to trade during the day. Remember, with ETFs, you can trade anytime during the day because they're on an exchange. And you like investing in taxable brokerage accounts. All right. This segment, we're going to talk about what's called mutual fund share classes. Mutual funds are have classes associated with them. You have what's called A shares, B shares, and C shares. They are classes of the same mutual fund. All right, let's understand that. They hold the same investments, but they differ in how and when you pay fees. And here's how. With A shares, you pay sales charge up front when you buy the fund. It's called a front end load, and it's typically can go up as high as 5.75%. Um, those charges are often reduced with larger investments. And with A shares, you'll pay lower ongoing expenses than you would with the other two. A shares are best for long term investors, larger investments, and buy and hold strategies. Why? Because of this example right here that's on your screen. If you invest $10,000 into an A share mutual fund, your upfront cost or the sales charge in the case of a 5.75% sales charge is $575. So what's actually going to work for you in the market is $9,425. So not all of the 10,000 is going to work. We say that A shares are long term because, first of all, it takes a while to get that money back into your fund so that you can start making money on top of the money that you invested. So you got to get that money back. So A shares are long term investments, anywhere from 5 to 7 years, we like to say. So that's the deal with A shares. B shares. First of all, you don't see a lot of B shares anymore, but this is the skinny on B shares. There is no upfront fee, but you do pay back end sales charges if you sell them too soon. Okay. There is also what is called a contingent deferred sales charge, or CDSC, and that declines over time. All right. And it often disappears in 5 to 7 years, but you will see contingent deferred sales charges. Also, you'll pay higher annual expenses with B shares. B shares are best for investors who plan to hold long term but do not want to pay the upfront fees. See, so you won't have that big chunk coming out up front. It's just assessed annually and little things, here and there with B shares. B shares, again, have been largely phased out due to the high costs. And then there's what's called C shares. C shares, there's no big upfront or back end charge, but they do have ongoing higher annual fees. And they have a small back end fee, usually about 1% if you sell it the first year that you've held it in the first year. C shares will have higher expense ratios that never decline. They're built into the fund. Remember, an expense ratio is the annual cost of owning an investment fund. It's expressed as a percentage of the money you have invested. We're going to talk about how to evaluate those later. Uh, it covers the fund's operating expenses, all right, such as management fees, administrative costs, and marketing and distribution fees, also known as 12B1 fees. C shares will be best for your short to mid-term investors, investors who are unsure of how long they will hold the fund. Remember this about share classes. All share classes own the same portfolio. Nothing is different about the portfolio. Over long periods, A shares usually cost less overall over long periods because you got that 500, that whatever that sales charge was, but not a whole lot else going on that you're being charged for. And then ETFs usually avoid all of those things to begin with. ETFs don't have hardly any of those. So let's talk about how funds work. Like anything, investors put money into the fund, and then the fund manager invests the money into a diversified portfolio. Remember that funds give you instant diversification. You spread your money across a lot of different stocks and or bonds within that fund. And investors then share in the profits and the losses of that fund. Okay. The profit, losses, and the income of that fund. The fund value, the way it's valued is, uh, in the case of mutual funds, it's what's called the net asset value. Okay. That's what you would buy a given fund at a given time. Whereas ETFs fluctuate like a stock price, right? Although it's a fund, it behaves more like a stock. And so net asset value is valued once a day, and that's it. All right. The minimum investment for mutual funds tends to be anywhere from $500 all the way up to $3,000. It really depends on the fund family as to what the minimum investment is. Some of them you can get in though for about $500. And that is lower, obviously, in retirement accounts. ETFs, on the other hand, you can get into them for about $50. Some of them can be, the minimum can be as high as like $300, right? So let's talk about risk as it relates to funds. So the risk varies by the fund type. If you have stock or equity funds, naturally, as I said, you're going to have higher risk. There's going to be higher potential for return and higher potential for loss, obviously. And then with bond funds, those are fixed income funds. You have lower risk, lower returns, just like you would with individual bonds. And then with balanced funds, those are more moderate risks. That's a mix of stocks and bonds. So, why would you buy funds? It should be obvious at this point now. The number one reason you should be saying diversification. Diversification reduces the risk compared to buying one single stock or bond. If you buy one stock, that's putting all of your eggs in one basket. If you buy one bond, again, that's putting all of your eggs in one basket. But if you buy a myriad of stocks and bonds, like you get with buying a fund, you are instantly diversified. Your eggs are spread all across the place. It's a beautiful thing. Secondly, you buy funds when you want professional management. As I said, fund managers are really sharp. They know investment world inside and out. These guys are highly educated generally, um, and they stick around with these funds for a long time. They're top quality, so you want to read up on them and find out who it is that's managing your funds. but they tend to be really top notch. People buy funds also for the convenience. It's easy to invest in multiple assets at once. And then the liquidity. You can sell mutual funds or ETFs relatively easily. That's why investors buy into mutual funds. You can buy mutual funds just like where you buy bonds, and some of the other, stocks. You buy mutual funds in several common places depending on how hands on you want to be. Meaning, you can buy through brokerage firms, as we said, as you see there, directly through Fidelity, Vanguard, Charles Schwab, E Trade, TD Ameritrade. And when you purchase that way, you have a wide selection of mutual funds. There's often no transaction fees on many of the funds. And they're easier, it's easy to manage them because you have other assets there at that brokerage house generally. That's why you would probably want to buy that route. You can also buy directly from the fund companies. You can go right to Franklin Funds or American Funds and buy that way. I don't see that happening a whole lot, but that's possible. Um, you buy straight from the company that manages them. There are many: Vanguard, Fidelity, T. Rowe Price, American, Franklin, Templeton. There's some really great funds out there. That's good for long-term investors. You're not trying to buy and sell a whole lot if you buy directly through the fund company. That's people who want to stick to one fund family when you want to buy directly that way. Buying from one fund family entitles investors to potential discounts on the sales charges that we talked about earlier. Those are called break points. So, what is a break point? It's a discount. So if you decide to, let's say, invest $30,000 into Templeton funds, you may have a break point at $25,000. So that could be the difference between, let's say, at $20,000 or at 25,000. Well, let's say $20,000, you paid, 5% sales charge. At $25,000, you get a discount or a break point, and it may go down to 4.5% sales charge. That's called the break point. And the reason why that's important to stick with one fund is if you put additional funds into it, you may hit another break point and get another discount. Whereas if you buy from multiple fund companies, you may have 20,000 there that you didn't get a discount on. You may have 15,000 in another, so on and so forth. So this is why you want to stick with one fund family. And then, of course, you can buy funds, mutual funds through your employer retirement plans, 401ks, 403bs, 457 plans, along with obviously traditional IRAs and Roth IRAs or simple or SEP IRAs. They're also available through brokerage or fund companies, financial advisors you can buy funds through. If you call a company like Fidelity, you may speak with a financial advisor directly. That person will answer any questions you may have, and then they recommend that you purchase a particular fund after they've spoken with you for a while, gotten an idea of your risk tolerance. Advisors, be aware, they may charge advisory fees. They may also charge commissions, especially on A, B, or C shares. Always ask about the fees and the share classes, because that tells you how the advisors and broker dealers are paid. So things you want to watch out for with mutual funds is: what's the minimum investment requirement? What are the expense ratios? You look at different fund families, look at the performance of those, and we're going to talk about how to evaluate them, but look at how they're performing. And if you have a fund with a higher expense ratio, but the performance is very similar, I think it would be wise to go with the one with the smaller expense ratio because you're going to be charged less. So you'll have more money going to work for you. And then you want to look at sales loads and commissions. You want to ask that question when you're dealing with financial advisors and transaction fees. All right. So let's talk about how to redeem or how to sell mutual funds. All right. So, how do you redeem mutual funds? You place a sell order, number one. So, if you have your assets at a brokerage account, you would log on to your account, you would click on sell, and then you would click on uh, or enter the symbol for your mutual fund. It'll pull up whatever shares you have, and then it's going to tell you to specify the number of shares or the amount that you want to redeem. And you finish that sale, and then in 1 to 2 days, that money will then appear in your brokerage account as cash, and then you can move it to your bank account. Cash settles in 1 to 2 days, and again, the money is sent to your cash account. There are some different things that you can do to evaluate mutual funds, and we're going to talk about that now. All right, so how do you evaluate mutual funds and decide how or if to purchase a particular one? I'm glad you asked. The number one thing you want to do is look at and read what's called the prospectus. Okay, the prospectus. The prospectus is the official document provided by the fund company. So when you buy or want to buy a fund, let's say one called American Funds, their growth fund, you would click on that in the brokerage account, and that will trigger a prospectus to be sent to you. Or if you call a brokerage house and ask them to send you a prospectus, then they will if you've shown interest in a purchasing a fund. The prospectus includes investment objectives, strategies, the risks, the fees, historical performance. And so you want to always start with the prospectus, and it is required that they send you one if you have expressed interest in buying a mutual fund. It's legally required. The second thing you want to look at is the fund's objective or its strategy. See if it aligns with where you're trying to go. That is what the fund aims to achieve. Is it growth? Is it income? Or is it both? If you are looking for growth exclusively, then you're not going to want to buy a fund that provides a lot of income because that's going to have a lot of bonds in it. Bonds don't grow, stocks grow. So you're going to be looking for more of a equity or stock fund. You want to look at how it invests. Does it invest in stocks, bonds, sector funds, or that is sector type stocks, or geography, right? So if you are not looking to be all over the map in different geography funds, you're not going to want to buy a fund that is trying to go into different countries and things, right? That may be outside of what you're looking for. So an example of a fund objective may be expressed like this: a large cap growth fund focusing on US technology companies. So large cap tells you that it is a stock based company that's investing in very large companies, the largest companies. So that fund is going to have a lot of big companies in it. And then it said growth fund. So it's looking for growth, right? Growth meaning it's trying to outpace the market. And then it says focusing on US technology companies. So it's a sector fund as well. Specifically, I can say that, specifically US technologies. So if that doesn't fit with what you're trying to do, then that's not the company for you, or it may well be. You want to also look at the history of the performance of the fund. That's why you're buying a fund, right? You're buying an investment to see how well it's performed. This one thing I spend a lot of time looking at. You want to look at the 1, the 3, the 5 year, and the 10-year mark to see how well that fund has done compared to what is called benchmark. That is the comparison that's generally used when it comes to funds. And that'll give you a really good idea of how well it's done. And then, of course, going forward, what your hopes and expectations can be for that fund. Because past performance is not a guarantee of future results. They have to say that. But it does show consistency. You want to also look at what is called the measure of risk. And there are different measurements for that. This gets a little deep, but here we go. You want to look at what's called the beta. Uh, and the fund with a beta of 1 is kind of right there on the market. And what beta is, it's a excuse me, it's the fund's volatility relative to the market, a fund's volatility relative to the market. So a beta of 1 is kind of on par with the market. If you get a beta of less than 1, then that's real good. If you get a beta of like 3, that's a very volatile fund. And I don't know, for me, that would be a little too much volatility. And then there's something called standard deviation, and that has to do with how much uh, it fluctuates. So it has to do with volatility, but more to do with the returns and how much they fluctuate. And then the other thing you want to look at is the rating of it. It's called a Morningstar rating. That's a very reliable measurement. Morningstar, very credible organization. And so it's a qualitative risk and return evaluation, the quality of the fund, qualitative risk and return evaluation. All right. So the other thing you can look at is the holdings to evaluate a fund. That is, what are the top 10 to 20 companies that are within that fund? You can get excited when you see certain names of funds within what the top 10 to 20 funds, because that generally is going to dictate kind of the direction of where that fund can go. And then you want to look at the fees and expenses, as we said earlier, the expense ratio, which is an annual cost, which is measured as a percentage of the assets you have at that fund. You want to look at sales loads and commissions. We talked about that earlier. Are there upfront charges? Are they back end fees? What are the 12B1 fees, which is the marketing and printing and distribution and all of that cost? Another thing you want to look at is who the fund manager is. I can't express this strongly enough. The fund manager can make or break a fund. That person should have a stellar track record, and you can read all about that person in the prospectus. That person should have a lot of years managing funds and in the industry. All right. So learn about the fund manager. Sometimes there are multiple managers, right? Their tenure matters in funds. Then you want to look at the size of the fund. The larger the fund, the better, because that means more stability. All right. Very small funds are going to be a little riskier. They're going to be harder to sell also because they're thinly traded. There's just not a big market for them. So you are what we call less liquid. And that's not something that you want to hear when it comes to mutual funds because one of the selling points for mutual funds is you are very liquid, but not with small funds. You want to look at dividends and distributions, how often the fund pays dividends or capital gains. All right. And those are the things you look at when you are evaluating uh, funds or mutual funds. All right. We are switching gears and we're going to talk about municipal bonds now. Municipal bonds are exciting. It is one of the uh, different bonds that we talk about in this class. So let's get started. So, what are municipal bonds? Municipal bonds are also called munis, short for municipal bonds. Just like any other bond that we talked about, they work the same way in that they are debt issues by the state and local governments, so cities, schools, and school districts, that is, transit authorities, and they're issued to fund public projects like schools, roadways, roads and bridges, that is, water, sewer systems, hospitals, and public utilities. So, just like any other bond, when you buy a muni bond, you lend money to a government. Right? So, you're lending money. A bond is a debt instrument and they in turn promise to pay you interest and also to pay you back all of your principal once that bond matures. So at the end, say 10 years of interest payments every 6 months, you'll get an interest payment with a muni bond. And if it's a 10-year bond, at that maturity date, at 10 years, you'll get all of your principal back. So, just like with a federal government bond, a muni bond has what's called a coupon or an interest that is paid, that's promised to be paid to the investor 3, 4, 5, 6%. All right. Interest is usually exempt from federal income tax with muni bonds, and they're often exempt from state and local taxes if you live in the same state as the bond that the bond was issued in. So there's a couple of different types of muni bonds. There's one called a geo bond or a general obligation bond or a geo bond. It's backed by the taxing power of the issuer, that is. It is backed by the full taxing power of the issuer. That's how um, geo bonds are repaid by taxes. And that issuer can raise taxes if needed to meet that need. They are considered very safe. Muni bonds are considered safe, not as safe as treasuries, but they are considered safe. City may issue a bond to fund a school. That's an example of a muni bond. Okay. And so the way it works is, let's say a city needs a road to be repaired. Let's say it's in pretty bad shape. So they may estimate it'll cost $20 million when it's all said and done, paving and filling in the patches and doing whatever else they have to do. So they'll issue a $20 million uh, general obligation bond to fund that project. And then over time, they'll pay you interest and then your funds back, your initial principal back. The second type of bond is called a revenue bond. Revenue bond is paid from specific uh, revenue uh, from a project, right? That's how it is paid back. There is no taxes going on, no taxing power backing them. It's fully revenue that's generated from different projects. And the risk depends on the project's success, like a toll road or an airport or a stadium, even. Right. So that's what revenue bonds are all about. Next, we're going to talk about how muni bonds pay you. Nothing different than what we've talked about earlier. There's a coupon, as I said, which is a fixed interest rate. You're usually paid semi-annually. Your interest, that is paid semi-annually. And at the end of that bond, at the maturity date, you will get your principal returned back to you. Tax treatment on muni bonds, they are exempt from federal income tax. They're often also exempt from state if they're, again, issued, if you live in a state where it was issued. And so just remember, when it comes to taxation on bonds, the mantra that he who issues the bond also taxes it. That's you can follow that pretty safely, and it'll be true. So how do you buy muni bonds? You buy muni bonds just like you do some of the other assets we've talked about, uh, through brokerage firms like Fidelity, Schwab, Vanguard. You can also buy them at banks and through bond dealers. Okay. Uh, the benefit of buying bonds is the predictable income. Okay, number one. Number two, you can hold them to maturity. So you can have something that goes for a long term and uh, the principal repayment. Okay. Drawbacks from buying bonds is that you're an individual bond is you're not diversified. It's just one instrument. And in the case of muni bonds, the minimum is going to be higher to buy into them. So you start at about 5,000, and in some cases, it can be as high as $25,000. Right. So as we discussed earlier, muni bonds can be purchased through mutual funds or ETFs, but you do not get back your principal in that case, like you would with individual bonds if you buy them through ETFs and mutual funds. Okay. So how do you redeem muni bonds? You hold them to maturity, number one, and you get back your face value. Secondly, you sell them on the secondary market, regular market. The price could be higher or lower. That's if you're selling it prior to maturity. Because remember, from the moment you buy a bond all the way to the maturity of it, the price of that bond is going up and down until you get to the maturity date. So if you decide to sell it before maturity, the price could be lower than what you bought it at, or the price could be higher. There are risks associated with muni bonds. Number one is interest rate risk. That is, the prices fall when interests rise, as we said with the other bonds. Anytime you're dealing with a bond, there is that inverse relationship. When prices go up, or when interest rates go up, prices of them fall. That's not important to you unless you sell it before maturity, because at maturity you get all of your money back, your principal back that you initially invested. Secondly, is obviously the credit risk. Not as big with munis because you don't expect municipalities to file bankruptcy, right? So not as big a deal. With One of the other risks is liquidity. It can be hard to sell some muni bonds. A market may not be as big in that case. And then inflation risk, because it's fixed income, uh, then you're going to lose some purchasing power. Inflation could outgrow what you're earning in muni bonds. So, what are some terms that you can expect to hear when you think about muni bonds? There's what's called par value or face value, and that's the amount that's repaid at maturity, right? Face value. Usually it's $1,000 per bond. Secondly, you'll hear the term coupon rate or interest rate. Same deal, right? Those words are interchangeable. You may also hear something called tax equivalent yield, and that's a yield that's been adjusted for tax savings. So, in the case of tax equivalent yield, it tells you what a taxable investment would have to earn to match the return of a tax-free investment. Okay. And then there's call date. Call date is the date that a bond can be redeemed early. This is one of the risks associated with any bond, by the way. They can be what we call callable. What that means is the issuer can choose to redeem it early. Why would an issuer do that? If it's in their best interest to do so, no pun intended. But if interest rates drop and an issuer is paying 5% on a bond and interest rates go down to 4%, then it benefits them to refinance it. That is, call it back from you and then reissue it at 4%. So, what they'll do is they will redeem your bond early. So, if it's important that your bond is not callable, then you want to buy a bond that is not callable, and it'll indicate it when you're buying the bond. One of the other terms you'll hear is maturity date. That's just the date that the principal is returned to you. And then you'll also hear bond rating, which is the credit quality. And there are ratings by Moody's and Standard and Poor's. And that is the skinny on municipal bonds. Next, we're going to talk about corporate bonds. So now we're up to corporate bonds. Corporate bonds is the third of all the bonds that we're going to talk about. Altogether, there are four. After this one would be your high yield or junk bonds. So, corporate bonds, just like government bonds, municipal bonds, they are loans that you make to companies. Again, a bond is a debt instrument. It is a company that is asking for loans when they issue bonds. And so when you buy a bond, you are making a loan to a company, and they are in turn promising to pay you interest on that bond, and they are promising to repay you your principal at the maturity date of that bond. Um, so you make loans to the company, you receive interest, you get the principal back at maturity. There are different types of corporate bonds. Number one, investment grade bonds. They are bonds that have higher quality. They're going to give you a lower yield as a result. You're not going to make as much with corporate bonds because they are investment grade bonds. They have lower risk, obviously, for that reason, and they have excellent credit, higher quality credit quality. And then there are what's called high yield corporate bonds. Okay, they are also known as junk bonds. So that's the second type of corporate bond. They're going to have lower credit quality. They're going to have a higher yield because they are riskier. Anything that involves more risk has a higher yield potential, but also a higher loss potential. Um, some corporate bond features, just like any other bond, you have a coupon that is a fixed, but in the case of corporate bonds, the interest could be a floating interest rate, not always fixed. Um, the maturity for corporate bonds would be short, intermediate, long term, just like the others we talked about. They are often callable because obviously corporations are very sensitive to interest rates more than the other entities would be that issue bonds. They are sometimes convertible as well, meaning they can sometimes convert to stock. There's a formula that the company uses when you want to convert a corporate bond to a stock, right? So, how are corporate bonds taxed? They are subject to federal income tax, state income tax, and capital gains tax. So, you get hit with all of them because obviously corporations can't tax you. You can buy corporate bonds through brokerage firms, uh, and minimally you start at about $1,000. Sometimes the minimum buying can be as high as $10,000. You buy them through bond funds and ETFs, where you'll have broad exposure, so you're going to be diversified. They're easier to manage in the case of funds and ETFs, uh, and but there is no return of principal guarantee. Remember, with funds, you don't have that as you would an individual corporate bond. You can redeem corporate bonds by holding them to maturity, number one, and getting all of your principal back. You can also sell them in the general secondary market, or of course, if you buy them through an ETF or mutual fund, you would sell them accordingly. What are the risks of corporate bonds? Credit risk, number one. Companies, these are companies that issue these. And so if the company defaults, you could be in trouble. Secondly, is interest rate risk. As we talked about, rates go up and down all the time. And so that's the case certainly with corporate bonds. And then the call risk. That is, the company can decide to redeem them early if it behooves them to do so. Liquidity is an issue with corporate bonds. What do we mean by liquidity? You should know that by now. They are thinly traded, meaning there's not a robust market for corporate bonds. And then, of course, the company performance, the business risk is a risk associated with corporate bonds. So let's talk about some corporate bond terms. With corporate bonds, you're concerned with something called a spread, and that is the yield that you get, the overall returns that you get above treasuries. So the higher that yield, the better, right? The higher that number, because that means your spread is bigger and you're making more over treasuries. So it's a bit of a comparison as well. And the difference there being the spread. Secondly, there's what's called the indenture, which is the legal bond contract. Um, There are covenants, which are rules that the issuers must follow. And you'll hear the term secured versus unsecured. That is, are the bonds backed by assets or not? If they're backed by assets, that's better than unsecured debt. Okay, because if something goes wrong and it's not secured, then again you're stuck out there. Um, So next we're going to talk about high yield bonds. We just discussed corporate bonds. High yield bonds is the second type of corporate bond, if you will. And it's also referred to as junk bonds. Remember, not because they're truly junk companies, it's just that the companies don't have as admirable a credit rating as would some of the other higher rated corporations. High yield bonds are lower rated corporate bonds that pay higher interest to compensate for higher default risk. So, because the potential is higher for them to fall into default, they pay you more. They pay you a higher interest rate. Um, the ratings, again, the credit rating is going to be less than stellar. And they're called junk bonds, as we said, because these companies have high debt, they have weak cash flow, the business is uncertain, and or they're companies in distress or even startups. Irrespective of all of that, they rarely go into debt, or they rarely go into default, I should say. So investors who buy junk bonds are interested in higher income, higher interest rates. They're interested in diversification. They may not have anything like that in their portfolio, and so they want to diversify over into um, high yield bonds. They may be interested in strong performance because they perform well, I should say, during economic expansion. Just think about it. These are companies. And so if the economy is expanding and doing well, then that means that companies are generally doing well. Bonds pay you just like any other coupon, just like any other bond. They have higher coupons generally, though. They are, again, often callable, and you can see large swings in the prices of bonds because the interest rates go up and down. That means that the prices of the bonds go up and down as well. You can buy junk bonds, um, individual bonds. They tend to have higher minimums. You want to do your research, and they do have a higher default risk. So, how do you redeem high yield bonds? You hold them to maturity, number one, like any other bond. You sell them on the secondary market, or you can, if you bought them through obviously a fund or a ETF, then you would redeem them accordingly. The risk of high yield bonds would number one be issuer fails and defaults on repayment. Um, the credit risk, obviously, for that reason, is a real risk. And then the market risk, they tend to be correlated with stocks because, again, these are companies we're talking about. And liquidity is one of the bigger risks with corporate, or I'm sorry, high yield bonds because they are very, actually, they can be frozen during crises, meaning if we go into a really bad market, what the Fed will do is freeze the stock market. And so that means that the companies are frozen as well. And then the last one, risk for high yield bonds would be call risk, meaning the issuer recalls them and redeems them early. Well, that wraps up um, this portion of investing made simple. We're gonna come back with some other jewels and tidbits, information that you're gonna want to know. So please stay tuned for future videos. And thanks for spending time with me. Bye bye.